Brian Manning here with your Friday update. Let's get right to it. Monday was a quiet news day. I think investors were still primarily focused on last Friday's really solid employment data and kind of taking it all in. So not much happening on Monday. Tuesday, mortgage-backed securities were up, stocks were down. A lot of this was based on oil prices. At that day, oil prices were floating around $36 a barrel. And it wasn't really that long ago, about a year ago, where oil was about $100 a barrel. So certainly putting some pressure on stocks there. In housing on Tuesday, CoreLogic reported that foreclosure and inventory for foreclosure is down 21.5%, which is significant. So right now, across the U.S., homes that are in foreclosure with a mortgage only make up 1.2% of the market. So certainly seeing considerably lower foreclosure activity compared to where we were, and certainly signs that the housing market is very healthy. Wednesday this week, quiet news day. We spent some time on Wednesday analyzing the difference in spread between 5/1 adjustable rate mortgages and a 30-year fix. So what's amazing is that ARMs are very appealing right now. On Wednesday this week, there was about 116 basis point difference between a 5/1 ARM and a 30-year fixed rate mortgage, which is incredible. Usually, the difference is about 90 basis points or just under 1%. So, right now, ARMs are making up around 7% of all mortgages being taken out in the U.S. And possibly if we move into a rising rate environment, we may see more of that. But certainly a huge spread there and definitely worth looking at. Thursday was a quiet news day. And today, mortgage-backed securities are rallying. That's benefiting interest rates. Stocks are just diving right now. All this primarily based off oil going under $36 a barrel. Lots of talk that OPEC is not putting control on the output and certainly bringing the oil prices down. So we'll have to wait and see what happens with oil. Next week, big week. Two-day Federal Reserve meeting that ends on the 16th. Most analysts expect to see a 0.25% rate hike. Also next week we get PCE, which is the personal consumption expenditure, which is the measure of inflation on the personal side. So if inflation is there and the Federal Reserve does raise rates, I know we've talked about this before, but wouldn't be uncommon to see this actually help mortgage rates, because inflation is the biggest enemy of bonds. And as there is inflation in the marketplace, mortgage rates will go up. So if the Federal Reserve rate hike actually keeps inflation under control, that would benefit bond markets, and you could see some benefits for mortgage rates there as well. I'm around all weekend. Would love to be part of your business. If you have anyone that needs to get pre-approved, please give me a call. I'll be around. I'd love to help you. Have a great day.